If you guys are familiar with NACA, NACA loves Class C because NACA, uh, they can't come out and say it, but they love like older homes to kind of regentrify an area. That's like NACA's sweet spot. So if you guys want like those interest-free NACA loans that people talk about, having a Class C home is going to be better for you to be qualified to get that interest-free loan from NACA compared to doing a newer home. And then the long-term benefits of Class C properties, the rental income, fund future investments, as we know, the perfect for legacy wealth via trust, as we all know how to structure trust, I imagine. The potential for forced appreciation with renovations, another cool thing as well, right? So if it's renovations involved and we have it through our business, we renovate, guess what? We could do another cost segregation study. Do that cost segregation study. It allows us to, instead of depreciating those renovations over a 27.5-year time period, we're able to depreciate it within a 5-year time period. So let's say all the renovations, theoretically speaking, cost, let's say $60,000. It costs $60,000. So instead of the IRS basically paying you $2,000 a year every year in a tax deduction because of that renovation that you're doing, if you do a cost segregation study, they'll give you all $60,000 of that in the first 5 years. So it allows you just to get a larger refund or more money throughout the year to use to invest in the stock market via your 401k or your 457 or your IRA, or invest in another business or real estate, which of course is a tax write-off as well. So those older properties give you ability through depreciation to do a cost segregation study that kind of gives you that money in a lump sum. So instead of the IRS paying you 27 years for fixing up a property, they pay it all within more of 5 years. So yeah. And also college towns. I know I may have briefly talked about it. My goddaughter, she graduated from high school. She's going through Bethune-Cookman, and with the money we kind of put to a college fund because she got a scholarship. Yay! She got a scholarship to pay for it. So the money we was going to use to kind of help pay for her college, we're actually now going to use that for real estate so that her second year, because her first year she has to stay on campus, but for the second year, we're going to find a Class C property where she'll be in it, rent it out. Won't be in her name, though. It'll be in the trust name. But we'll rent it out so she can kind of see how it works from an entrepreneur standpoint, and then she gets the cash flow. So perfect for college towns. All our clients that have children will go to college, and we try to find a way their second or third year to buy some type of property. So instead of money going to the college or going into an apartment complex and never get it back, how can it come to them and build generational wealth? So if you guys have any children or grandchildren that's about to go to college, let's talk. And we can find ways to make sure that that money doesn't go to the dorm or a apartment complex or somebody else. It goes to you guys through your trust. Next, as we kind of go along. All right. So portfolio line of credit. So if you have investments, you can actually do a loan against your investments. You can't do it against your 4K. I'm sorry. You can't do it against your traditional IRA. If you have a 4K, you take a loan against it. If you have a 403B, you can take a loan against it. If you're actively working for that company. If you no longer work for that company, you can't take a loan against it, but you can take a loan against a 401k and a 403b. If you have some type of retirement fund where it's like a retirement fund, not a 401k, but like a fund, and they call this a deferred compensation, not deferred comp, 457, but a deferred compensation, then you don't have access to that either. You can borrow up to 70% of that. It's interest-only payments, but you're paying yourself back. Right? If you take a loan against it, you're paying yourself back. There's no taxes, so you don't pay any taxes on it. It could be used for business, investing, or personal needs. And very important, I know we talked about it last time. If you guys have children or grandchildren and you want to do an UGMA account or an UTMA account, you can also borrow against that. So you're putting money into the UTMA account or you're putting money into the UGMA account for your child so they can get it when they turn 18 or 21. You can actually borrow up to 70% of that, so not sell it, but borrow against that and then use that money to maybe do real estate or maybe do a party for them or buy their car, right? So you can buy their car without having to sell it. And we can all do that through SBLOC or a portfolio line of credit, which we do, for clients at the time. So we find ways for you to get money without selling your assets. So example, if I got $100,000 in the index fund, if I borrow $70,000 at 5%, I invested in something else making 10%. Guess what? I made money, and the money I make pays the interest. If it's structured properly, then of course that interest that you have, you get to write off on your taxes as well. So borrowing to invest when you break even to win. I know I talked about it previously, but just as an example, borrow $100,000 at 6%. I do a real estate 7% ROI. I make a 1% net return. Doesn't feel like I made that much, right? But the taxes that you save is money that you continue to save every single year compared to if we borrow money and put it into a stock. Again, we love the stock market. Love stock market. You're going to make more money in the stock market than real estate. But from a tax standpoint, the IRS, they reward you investing in real estate tax wise compared to investing in a stock unless it's a 4K. So another cool thing you guys could do is called asset based lending. A lot of people don't know if you have furniture or equipment in your business, you can do a loan against that. I have a client that has an event space. He has an event space in Wisconsin, and he wanted to do a large event, but he didn't want to pull money out. So where do you get the money from? Where you get the money? Well, he was able to structure a loan with the company where he put up from an asset standpoint his furniture. So very, very cool idea. So your inventory, you have to inventory your assets first, right? So your desk, your computers, your office chairs, printers, etc. If you guys don't do this, our business owners, we recommend inventory your assets every single year. Do it because again, you could depreciate that from a tax standpoint. So if you're not doing it, if you have an office, even if you are leasing the office, if the equipment is yours, inventory that so you can be accurate when you depreciate those assets every year. Get a valuation. Lenders want to see a depreciation adjusted value. So they want to see it. So if you don't inventory your assets, then how can you really show the depreciation of them, right? Apply with the ABL lender. It's a special lender. It's special lenders out there called ABL lenders, asset-based lending agencies that specialize in equipment-backed loans and sale leaseback programs, which I'll talk about here shortly. The loan terms are usually 30 to 70% of the appraised value. So let's say your furniture, your computers, everything is all worth $20,000. Then you'll be able to get, $6,000 or $14,000. The interest rate is, 8 to 15%. So I say 10%. So it is a little bit higher than like if you do a HELOC loan, but some people don't want to put a house up from a loan standpoint, so your furniture. Then also the terms usually 3 years, and you can renew them, right? Some are auto renewable, some not, but usually we see those for 3 years. Also, a sales back feature as well that you can do that they did about clients in Wisconsin. So this is what you do, right? So you actually sell your furniture, your fixtures, your equipment to a lender. So you're selling it to them. So once you sell it to them, they then immediately, because it's a contract, they then immediately lease it back to you, right? So you sell them the furniture, but then they lease it back to you. So you are retaining the use, right? So it's not yours per se from an ownership standpoint, but you are using it, you retain it. It's a way for you to kind of get an infusion of capital, right? So you get the money up front. Now that is taxed at a capital gain, right? Not income tax, which is important. Because again, income tax is your tax bracket. A capital gain is 10 to 15% depending on your tax bracket. 10% the low end was equal, actually 0% the low end if you make less than $25,000, but in between 10 to 15%, right? So you're taxed. However, though, the lease payments that you pay because you're leasing your furniture, right? I mean, you're leasing to them. So the lease payments you pay to them, right, after they give you the upfront cash, that is tax deductible. So they sell it to you. Yes, you got to pay capital gains taxes, but then the payments that you pay are tax deductible. Well, if it's tax deductible, it's based on your income bracket. So if my income bracket is 24%, I'm deducting 24%. I pay for something, it costs me 15% from a tax standpoint, but then I deduct the payment, which is 24%. So if I pay 15, I get back 24. That's a 9% tax saving for you. And then, of course, once it's paid off, then it's an agreement where it gets sold back to you at $0. So that's called sell leaseback agreement, a way for you want to raise capital through your business and you don't want to do any loans or anything of that nature, tying up your personal property or anything else, you can definitely do it with your furniture. So, I don't know if you guys knew about that, but something that you guys can definitely do And it's a way for you again to have more funding without having, in this case, the bank having access to your
Oh, yo,
house
can
if
I
something
just
happens.
ask a question right quick? This is
Yeah,
Shed.
of course. Yeah, of course.
Okay, who are some of the lenders that we can do that with our assets like that? We could sell it, not sell it, but lease it to like that. Because I didn't get the names of
Yeah, yeah. So, but we can email you a list of lending companies.
Roger that.
That yeah, we could definitely send you a list of those
Awesome.
lending companies. For what um I just want to you mean for the sale leaseback, like what lending
Yes,
company?
the
Because
sale back
lending
lease,
companies are different
exactly.
things. So what,
For the sale
okay,
back
yeah, yeah,
lease.
yeah, yeah.
Yeah, or like furniture, it's different your things of your asset like that that you could at least put it up for instead of you trying to get loans. And that's what I'm trying to do
Yeah.
now for my business. I like that idea now.
Because again, we have our S plus S equals wealth. So you have your structure, your strategy, and speed. So it's a good strategy, but we first want to have the structure first. So you want to make sure that you have an inventory of everything that you have, because if you don't have that inventory, then how can a lender base something, right? And then also from a tax standpoint, you want to make sure if you have the inventory, you have your depreciation schedule from a tax standpoint, so it's on paper. Because you can say, it's worth this, is that. Well, if it's not on paper, then is it really worth that? So definitely we want to have that inventory list. Then also from a tax standpoint going forward, we definitely want to make sure that we have that depreciation, when we file, as well. So, we're in compliance with the IRS, and we get the best bang for our buck when we do the asset-based lending, or if we do the sale leaseback. But yeah, cool, cool, cool. Anybody else wants that list of the companies? I definitely put in the chat as well. All right. So last thing. So structure so it won't affect your business. So if you do this, right, again, from a structural standpoint, it's very important to have things structured. You want to form a second LLC that owns your equipment, because what you don't want to have happen is that, you do the asset based lending and hard times fall and you can't pay, right? So then they go after now your business, right? So again, from a liability standpoint, to separate things, right? To make the things are separated, personal and in your business is plural. We recommend you form a second LLC that owns the equipment. So you have your LLC, you're operating, that's, kind of paying the bills and bringing in the money. But then you have a second LLC that actually owns the equipment.